Welcome to the second video in our class for March 11th. In the last video, we reviewed accounting for three types of debt investments and accounting for equity investments that have no significant influence over the investee, holdings of less than 20%, or in other words, the fair value method. In this video, we're going to learn the accounting for equity investments in which we do have significant influence. Here we're talking about holdings of approximately 20 to 50% of the investee's common stock. This is so much of the investee's common stock that we assume the investor has significant influence. Because the investor and the investee are so closely related, this is going to affect the accounting treatment. The accounting treatment is called the equity method. Remember, when it was less than 20% or no significant influence, just like a regular stock holding, we value the investment at the fair value of those the shares of common stock. The accounting for equity investments using the equity method is much different. The investment in the investee is initially recorded at cost. Now, that's not any different than what we've covered before under all different types of investments. Every method we've used, the investment is always initially recorded at cost. What differs is how this investment changes later. So in the past, we've typically said at the end of the period, in certain scenarios, we adjust the investment for changes in fair value. Here we do something very different. The investment account we have no separate fair value adjustment. It's directly to the investment account, is adjusted each period for two things. Now, before I get into these two things, I want you to think back to perhaps the very first section of Accounting 221 and again, the very first section of Accounting 331 when we were just talking about the accounting cycle. Transactions were recorded, company would recognize revenue, recognize expenses. Then at the end of the period, all the adjusting entries would be recorded, the trial balance would be refreshed, and the financial statements would be prepared. But do you remember that last step after the financial statements are prepared? Closing entries are recorded. And what happens with those closing entries? We focused on the bookkeeping aspect, but if we think about big picture, what happens to all of the income of the company at the end of the period? That income gets moved to an account on the balance sheet. Do you remember what account that is on the balance sheet? And I'll give you a hint. It's a stockholders' equity account. Hopefully you said retained earnings increases. At the end of the period, net income increases the company's retained earnings. What decreases the company's retained earnings? You may have said expenses, but remember expenses are part of net income. So yes, revenues increase retained earnings, expenses decrease retained earnings. One other item decreases retained earnings, and that's dividends. That's the principle we want to keep in mind as we go through the accounting under the equity method. So we hold so much of the investee's stock that we say a portion of that net income of that investee is ours, and a portion of those dividends are ours. But the same way that for a company on its own net income increases its retained earnings and its dividends decrease retained earnings, we're going to see that same philosophy apply here. Okay, so the investment account, remember the investor's asset of equity investment in an investee, the investment account is increased by the investor's proportionate share, because remember we're talking about holdings between 20 and 50%. So we're saying if the investor owns 30% of the investee's common stock, the investor is going to record 30% of the net income, or of course the net loss. Of the investee. So if at the end of the year the investee has income of $100,000 and the fair value of the price of this investee's stock has gone up $3 a share, what do we do at year end? We ignore the fair value of the stock and we simply record if we own 30%, we get 30% of that net income is going to increase the investor's equity investment account. And remember, what else affects a company's retained earnings aside from net income or net loss? It's also the dividends. So now we're saying our investee declared dividends. What happens to us? We collect the cash that's being paid, but then what's the other side of that entry? Under the fair value method, when we got dividends, we said that dividend revenue went up. Now what we say is the value of our investment account decreases. So the investment account is adjusted each period for dividends received by the investor. Dividends received by the investor reduce the equity investment account. Now let's look at an example. Example 1, this is on your worksheet. If you saw on Blackboard, there's examples for class, part 1 for the investments. That's what we're looking at. Here it is on a PowerPoint. Carlton Company purchases a 30% interest in Rockford Corporation on January 1st, 2019 by acquiring 48,000 shares of common stock at a cost of $10 per share. The following information is available to Rockford Corporation. Okay, so for the next 2 years, we have each year's net income. We have the value of the fair value of the common stock at year ends. And at the bottom, the instructions say record Carlton's purchase of Rockford Corporation stock and the necessary journal entries for 2019 and 2020. Okay, so the first thing to keep in mind is we have two companies here. We have Carlton, the investor, and Rockford, the investee. We need to always keep in mind whose books we're doing the accounting for. In this case, we are Carlton. And if you have a hard time remembering that, here's a little video clip that I want you to keep in mind and hear me in your mind saying we are Carlton. Okay, let's keep going with our example. Okay, hopefully you have your example written out next to you. The first thing that we want to do is record Carlton's purchase of the common stock. This is easy. Remember, every time we're recording a purchase of an investment, whether it's a debt investment or an equity investment, this is the easy part. We're going to increase the amount of our equity investment by the cost, and we're going to decrease cash, the amount that we spent. So 48,000 shares were purchased at a cost of $10 per share. The next item in transaction A, it says that Rockford recorded net income of $180,000. So it's important to remember here that we are using the equity method, and so we care about our investees' net income. We need to record our proportionate share of the investee's net income. And how do we do that? We're going to increase the value of the equity investment account for our portion. We get 30% of the $180,000 of the income, or $54,000 worth. And what's the other side of that entry? Well, I haven't told you yet. The other side of that entry, it needs to go to the income statement. So we increase the value of our investment. The other side of that goes to the income statement in an account called investment income. Where would that be reported? Well, it depends on the type of company. If we're talking about an investment bank, if Carlton here is an investment bank, that would be through operating income. If Carlton here was anything but an investment bank of some sort of a financial services company, if it's a manufacturing company, then that investment income clearly is going to go through the non-operating section on the income statement. Okay, that's it for part A. In B says at 12/31/19, Rockford's common stock had a fair value of $12 per share. What do? We ignore that. Because we're using the equity method, we ignore the fair value. Only thing that affects us is income, losses, or dividends incurred by Rockford. C, on January 28th, 2020, Rockford announced and paid a cash dividend of $100,000. See if you can think about, maybe pause the video here, think about how you might want to record that entry. Come back. Okay, so we're going to receive cash. We are the stockholder. Our investee, the company whose stock we're holding, paid out dividends, so we receive cash. We have a 30% interest in Rockford, so we get 30% of the dividend. And what is our credit going to be recorded to? Well, remember up here we said dividends received by an investor reduce the equity investment account. So we're going to credit the account equity investment. Okay, D, time goes on. It's the end of the year 12/31/2020. Rockford Corporation reported a net loss of $60,000. So now Carlton needs to record 30% of that net loss. What's going to happen? We are going to debit to reduce investment income by 30% of the $60,000 loss. And what account are we going to credit? The equity investment account to reduce that asset equity investment. Remember, these two companies are closely related. That one company's loss is a loss for the other company. E, at 12/31/2020, Rockford's common stock had a fair value of $11 per share. What do we do with that? Well, when we're using the equity method, we ignore the fair value. And that's it for example number 1. Example number 2 will be done in a separate video.